Netflix is currently trading at over $1,200 a share. Our rigorous analysis shows its fundamental value is closer to $497. You heard that right. We are initiating coverage on Netflix with a sell rating. Why? Because the market is pricing in a decade of pure perfection. And in investing, perfection is a dangerous price to pay. This is our deep dive. First, let's be absolutely clear. Netflix is a phenomenal company. It is the undisputed king of global entertainment. They have successfully navigated a critical pivot from a pure subscription service to a diversified, high-profit giant. Their move into advertising has been brilliant. Their free cash flow generation is powerful. Their content mode is massive. The market knows all of this, and that's the entire problem. The narrative you just heard, the story of Netflix's successful transformation, isn't a secret. It's the consensus, and the market has taken this consensus narrative and driven its valuation to an unsustainable extreme. To justify today's price of over $1,200, you have to believe in a perfect future. A future with no competitive pressure from Disney or Amazon. No regulatory friction on ad tracking. No macroeconomic headwinds. We believe that's an impossible scenario, and it leaves zero margin of safety. So, let's break down the actual numbers. Host analyzes. We built a comprehensive 10-year discounted cash flow, DCF, model to find Netflix's intrinsic value. A DCF model just forecasts a company's future cash flows and discounts them back to what they're worth today. And we were actually generous in our assumptions. We assumed their ad tier continues to boost profits. We assumed they keep growing internationally. We assumed they successfully expand margins. After all that, our base case valuation came out to $414 per share. Now, you might say, $414? That feels low. Their ad business is a game changer. We agree. So, we added a 20% qualitative premium on top of our DCF value, just to account for that massive ad potential and management's strong execution. And our final, optimistic price target lands at $497. That is our best case, fundamentally driven valuation, and it is 150% below the current market price. So, let's flip this. What does the market's price of $1,241 imply? We ran the numbers backward to get to $1,241. You need to believe Netflix will maintain its high-growth revenue for nearly a decade straight. Its free cash flow margins will expand to over 30%. Its risk profile, WACC, is far lower than it is today, closer to 5%. That isn't just an optimistic scenario, that is a fantasy scenario. The current stock price is built on an unstable foundation. Look, the management team is smart. They even told you this was coming. Remember their announcement that they're stopping their regular reporting of subscriber numbers starting in 2025? The bullish take is, this shows confidence. They want you to focus on revenue and free cash flow. The realist take, and our take, is, this reduces transparency. It makes it harder for investors to model the business and assess the health of the user funnel. It allows management to control the narrative, while the verifiable data points disappear. So, what's the bottom line? We love the company. We hate the stock. The risk-reward profile at this valuation is severely skewed to the downside. You are paying for a perfect future, and any small slip-up, a competitor's hit show, a new privacy law, an ad tech stumble, could cause a severe correction. This is not a momentum trade. This is a call for long-term, fundamental investors. Our recommendation is clear: sell Netflix. We believe the stock will eventually have to reconnect with reality, and when it does, it won't be pretty. What do you think? Is Netflix priced for perfection, or is it just getting started? Let us know your thesis in the comments below. And if you want more data-driven, no hype analysis, make sure to subscribe.